Welcome back to Miller Momentum. Today, we're doing a deep dive into one of my absolute favorite ETFs, FolioBeyond's Alternative Income and Interest Rate Hedge ETF, ticker RISR, but people often call it RISR. Since inception, it's been beating the S&P 500 handily. Indeed, while everything else was crashing in 2022, the RISR or RISR ETF was having its best year. How is this possible? Well, soaring aloft on RISR with increasing rates can feel like you're on top of the world, but there's a catch. Here, let me show you. No! Out of control! Yup, it's all about the Fed rates. You see, the RISR ETF functions a lot like an inverted version of an extended duration Treasury ETF such as EDV. So, if the Fed cuts rates, EDV will skyrocket and RISR will fall out of the sky. But if rates go up, RISR skyrockets and EDV crashes instead. So let's get into why RISR and EDV behave like this. Because bond market investors have been using zero coupon treasury strips and mortgage-backed securities interest-only strips longer than McDonald's has been using chicken strips. But before we dip into the nuggies of the market, I'm not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Let's start with the thing that keeps bond investors up at night, what I like to call the bond investor's dilemma. Bonds and interest rates are on a seesaw. When rates go up, the price of a bond you already own goes down. And the longer dated the bond, the more violent that move is. The gut punch of the last few years, especially 2022, was that in a real rate spike, almost everything in a normal bond portfolio falls at exactly the same time, though not always the same rate. Diversification inside bonds didn't save people in 2022, for the most part. But there's a small corner of the bond market that does the opposite. It actually goes up when rates rise. So, catastrophe bonds, for example, they're kind of impervious to rates. They don't care about them. But we're going to talk about a certain class of bonds that actually does care about rates in an opposite way to a normal bond fund. So, before we go further, I want to talk a little bit about the concept of duration. And like I said, just forget the textbook definition for now. Think of it as a seesaw that tells you which way a bond's price tips when rates move and how hard. So, positive duration is normal for bonds. Rates go up and your price goes down. That's your total bond market fund, your 30-year treasury, basically everything except stuff like cat bonds and a few other items. Then there's negative duration, and that's the mirror image of the normal bond world. Rates go up, and the price actually rises with them. Almost nothing behaves this way, which is exactly why a lot of people find it so valuable as a hedge for bond portfolios. So EDV, which is Vanguard's Extended Duration Treasury Bond ETF, and RISR, which is FolioBeyond's MBSIO ETF, they sit at opposite ends of the rate seesaw, with RISR being the rare instrument that actually goes up with rates. So, where do these strange mortgage-backed securities interest-only strips come from? And they're called MBSIO for short. Well, start with a normal mortgage-backed security. It's a big pool of home loans, typically. Every monthly payment a homeowner makes has two parts, as a lot of us very well know: interest and a chunk of principal. Wall Street figured out you can literally split those two cash flow streams apart and sell them as separate securities. And that's what's meant by stripping. You get a principal only strip, the PO, and an interest only strip, the IO. The PO holder gets the principal payments, and the IO holder gets only the interest part of the payment. For this video, we're going to ignore the PO for the most part. The IO, the interest slice, is the weird, powerful instrument that we're chasing and which RISR actually invests in. And its behavior comes entirely from the fact that it only ever collects interest. Here's the mechanic that makes everything click together inside RISR during rising rates. So an IO strip pays you the interest on that mortgage pool every single month, but only for as long as the underlying loans are still alive and people are still paying on them. The instant a homeowner, like you or me, refinances or sells our house or otherwise pays off the mortgage, that loan drops out of the pool, and the interest it was throwing off to people who are invested in something like RISR just poof, it vanishes. It's just gone. There's no principal waiting for somebody who's investing in MBSIOs, because that part of the payment got sold to someone else, not them. So the entire value of an IO comes down to one question: how long will these mortgages stay outstanding? Long-lived loans mean years of interest checks. Loans that pay off early mean your income dries up a lot sooner than you expected. Now, note what happens when rates rise. When rates go up, mortgage rates go up too, as we all know too well, which means fewer homeowners refinance because nobody swaps a cheap old loan for an expensive new one. Fewer refinancings mean the loans in your pool stick around longer, and loans that stick around longer keep paying you interest for more months. So a rise in rates literally extends the life of your income stream, and the IO becomes more valuable. Rates rise up, price goes up. That's the negative duration we defined earlier, and now you can see it's not magic, it just falls right out of how mortgages and refinancing actually behave. Now meet RISR's opposite twin, EDV. You can strip a Treasury bond in much the same way as you strip a mortgage. You pull the pieces apart and you sell them separately. So a Treasury strip is a bond boiled down to a single payment far in the future with no interest checks along the way whatsoever. You buy it cheap today and get one lump sum at maturity. One of the most popular ways for retail investors to own these is Vanguard's ETV, which holds a basket of 20 to 30-year Treasury strips in an ETF wrapper. Because there are no coupons and the payoff is decades away, EDV has an enormous positive duration. I think it's about 24 years. That means it rockets up when rates fall and gets crushed when rates rise. It is the purest long-duration bet you can make with government bonds, and it behaves exactly opposite to our IO in RISR. Both EDV and RISR are strips for the most part. Both are built by pulling apart a bond's cash flows. Both are high credit quality. Agency mortgages are effectively AAA, and treasuries are the benchmark for safety. So far, both of these ETFs are twins. But everything that matters for investors is inverted. The treasury strip's payday is a fixed date written into a contract. You know the day when you get paid. The IO's payday depends on millions of homeowners collectively deciding whether to refinance or not, so its timing is genuinely uncertain. The Treasury strip has a huge positive duration and hands you one payment at the end. The IO has negative duration and showers you with income along the way. Which brings us to the one risk that only the IO carries, and I really want to emphasize this. A Treasury strip has zero prepayment risk. The government can't decide to pay you early. The date is locked. But an IO lives entirely at the mercy of homeowner behavior. Prepayment just means borrowers refinancing or selling their homes and paying off the loan, right? And here's the cruel part: prepayments actually speed up exactly when rates fall, which is precisely when your IO is already losing value. People are rushing to refinance their homes at those lower rates. So the pain compounds. Some IOs are what traders call cuspy, sitting right at the edge where even a small dip in interest rates triggers a flood of refinancing. This is what is often referred to as negative convexity. And it's the reason you don't just buy an IO and forget about it. These things demand active, expert management, which sets up why a fund wrapper like RISR can make a lot of sense. Now, the part that makes IOs genuinely special is this. If you just want to profit when rates rise, there are blunt tools for that. You can short Treasury futures or buy put options on bonds. The problem is, those positions bleed money every day you hold them. That ongoing cost is called negative carry. You're paying rent on your bet. The IO flips that completely because it's throwing off all that mortgage interest. It actually pays you to hold it. Historically, something like 5 to 8% a year in current conditions. And that's positive carry. So you're getting income while you wait for your rate hedge to pay off instead of paying for the privilege to hold something. And note the contrast with EDV. EDV pays a yield too, but it's long duration there. You're not hedged against rising rates. You're fully exposed to them. I mean, EDV exists to hedge against falling rates. In fact, that's what most people use EDV for because market crashes tend to coincide with falling rates. But not always. Sometimes the Fed does not cut rates during a crash to stimulate the economy. We saw what happens in 2022 with that scenario. A quick but important word on credit is needed here because I think the phrase mortgage bond still makes people flinch after the whole 2008 fiasco. The IOs we're talking about here are agency mortgages. They're issued or guaranteed by Ginnie Mae, Fannie Mae, or Freddie Mac. Ginnie carries the full faith and credit of the U.S. government. Fannie and Freddie carry an agency guarantee backed by a Treasury credit line. In practice, that's top tier, effectively AAA credit. You are not making a subprime bet here. This is one subtlety, though, with an IO that's important to keep in mind. If a borrower defaults, the guarantee makes you whole on principal, but for you as the IO holder, that default behaves just like an early payoff. So if there's a lot of people defaulting on their mortgage, then the IO goes away too. It removes the loan and stops your interest. So even with pristine credit, prepayment is still your real risk. And prepayment, ironically, can come in the form of a default. Treasury strips, by contrast, are as clean as it possibly gets. I mean, they are a direct obligation to you from the U.S. Treasury. So, how professionals actually use these is quite interesting. The IO has always been the hedger's tool. If you run a big portfolio of regular bonds that gets hurt when rates rise, you can bolt on some IO exposure as a negative duration overlay. It rises when the rest of your book falls, smoothing the ride. And it pays you income while it sits there. So, IOs are used in kind of the same way that predominant equity investors may use instruments like EDV. For people with big bond portfolios, RISR saves their bonds when the bond market crashes, so to speak. So, yeah, it's really cool. Mortgage servicers hold IOs as a natural hedge since their servicing business also depends on loans not prepaying. The Treasury strip plays two very different roles. Pension funds and insurers use them to match long dated future liabilities. So they know they owe money in 25 years, so they'll buy a bond that pays in 25 years, so the money comes to them right then, and they'll, look around and make sure that the money that they're getting is what they need for the loan. Works great. And traders use them as the maximum horsepower way to bet on falling rates or as a portfolio ballast that rallies hard in a recession. So RISR is a shock absorber. EDV is either a precise liability match or a turbocharged rate bet. In fact, I heard something funny the other day that EDV is basically crypto for boomers, which is admittedly kind of hilarious because people did use extended duration treasury strips, especially in the 80s, as a way to bet and make just insane amounts of money in a short amount of time. A lot of the way that people use crypto now. And to be clear, I don't like crypto, and I don't really believe in using extended duration treasuries that way, but people have used them like that. Let's zoom out and put everything on the same map here. The duration spectrum running from negative on the left to very long positive on the right. Way over on the left in the negative territory sit our IO strips and the riser fund. It's roughly -5 to -10 years in its duration, that is. Near zero is going to be where cash is going to be sitting. Things like SGOV and VTIP, they're very near zero. And that barely moves with rates. A little to the right is the total bond market, the aggregate bond market, AGG, BND, BNDW. If you're a more of a treasury person, then IEF. And so then far, 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 far out to the right is going to be EDV at about 24 years positive duration. And the takeaway here is that, well, RISR and EDV live at opposite ends of this line. So if you own a normal bond portfolio, you're sitting somewhere in the middle right. And adding a pinch of the far left instrument, RISR, is going to be how you pull your whole portfolio sensitivity back toward the center. If, for example, you're mainly interested in steady, reliable, predictable income. So, how does an ordinary investor actually get this exposure without trading complex mortgage derivatives themselves? Well, that's where RISR comes in, right? It's the FolioBeyond Alternative Income and Interest Rate Hedge ETF. It's an IO strategy packaged in an ETF that anyone can buy on pretty much any brokerage account. It's actively managed, and that matters because in this case, it's a very good thing. Remember, these instruments need a steady hand on the prepayment risk. It holds agency MBSIOs, it adds treasuries when the managers want to fine tune, and targets a duration of roughly -5 to -10. So, in plain terms, it's engineered to go up when long term rates go up, while paying you an attractive income along the way. And that active management comes into play when rates are going down to control the damage and the pain. So, because it moves opposite to a normal bond fund, historically it's shown a negative correlation to aggregate bonds. And so it's a great diversifier for a bond portfolio. Now, neither of EDV or RISR is a free lunch, and neither is quote unquote better. They're opposite bets, right? And the right one depends entirely on your view and your portfolio needs. The IO and RISR, they shine when rates are rising or just holding steady. And especially when the yield curve steepens, that's when you get paid your carry and the hedge pays off because rates are increasing fast. Their weakness is a sharp drop in rates when a prepayment wave can really bite and people refinance. EDV is the mirror image. It's your friend when rates fall in a recession or a flight to safety. And it's the cleanest way to make a pure bet on lower rates, if you want to play the game of boomer crypto. But it gets hammered when rates rise. So the practical move for most people isn't going to be picking a winner. It's understanding that you can hold a little of that far left instrument to offset a bond predominant portfolio that's naturally tilted right in duration if you're worried about that. The trick is to match the tool to an actual view and size it sensibly. And hey, hedge is in the name of this ETF. They're telling you exactly how it's supposed to be used. But does the RISR ETF actually work? Well, let's take a look. We'll go back to inception, which is about 5 years ago now. So we've got our classic 60/40 total US stock market, total bond market on the left. And we've got a modified version on the right with 10% put in riser, which is pretty much the recommendation from Folio Beyond and the use case that they model in their own slide deck advertising their fund. So let's see how it worked out. So as you can see, 60/40 didn't do actually as bad as people say that it did. I mean, a 7.49% rate of return annually is not actually bad historically. But when you put 10% in riser, it does help considerably. The max drawdown is improved, the average drawdown is improved, the longest drawdown is improved. It helps with volatility, helps with the Sharpe ratio. So far, yeah, looks like it's been helping. And if you did, regular monthly contributions here, um, you know, modify the right one there, switch that to monthly. You can see it's also going to have a positive impact on your money weighted rate of return. So far, so good. But 5 years isn't really all that long when you think about it. And you know me, I'm all about stress testing strategies using backtests. After some serious internet sleuthing, I found on the ICE index platform the ICE Bank of America U.S. Agency Collateralized Mortgage Obligations, that CMO, Structured Interest Only Index, CSIO. I also found um, a companion or related index, the ICE BOFA US Agency CMO Trust IO index. So these are a little bit different from a homeowner's pool, but they're going to have roughly the same shape. And so I took the both of these indices and I took the data for the past 10 years from the data tab and I downloaded it and uploaded it into testful.io. So we've got four things loaded into testful.io here. We've got our CSIO index that we downloaded from the ICE BOFA website. We've got our CTIO index that we downloaded. We've got the RISR ETF itself, and we've got this really arcane riser sim structure that I created to roughly match riser's shape based on taking the daily federal funds rate, leveraging it by 3x, so 300%, taking a zero return interest and doing negative 100% exposure to that so that I could stack on top of this a inverse 60% exposure to intermediate treasuries and a 40% inverse exposure to long duration treasuries. And the idea here is to simulate the rough duration of what's in RISR without the drag costs of directly shorting treasuries. So, testing all four of these out, we could see that actually the closest is my construction of riser sim shown by that blue line there. But CSIO and CTIO still have a very similar behavior to riser. Now, the correlations on these aren't spectacular, but you know, I do feel encouraged that Riser Sim and Riser are fairly close together, and in terms of a moderate positive correlation, which means the shape is going to be a little bit comparable at least. Now, when we zoom out more, we take away riser. Now, CSIO and CTIO are real IO strips. So they're going to be invaluable for evaluating whether or not my little arcane structure over here of riser sim is legitimate to get a feel for how strategies behave. Again, riser sim is in blue. We saw in the last visual that CSIO was the most similar to the Riser ETF. So it is encouraging that we're seeing a very similar shape between the Riser SIM that I created and the CSIO index. Uh, it's not perfect, but again, it's a general behavior that we want to see here. And this allows us to have confidence that Riser Sim is going to at least give us proximate behavior of what it would look like to have had Riser in a 60/40 portfolio. So I'm just going to go ahead and show you right now, add 60/40, and then do a 60/40 with our Riser Sim. And a 60/40 with our CSIO. And you can see that the 60/40 with the CSIO and the Riser Sim, they're fairly comparable. The red and the yellow line are right on top of each other, and our 60/40 and the blue line is down there. Under normal circumstances, we're seeing that there's not much divergence here until you hit a year like 2022, and you've actually got positive rate movement upward, and the hedge does appear to be working long term historically here, both with the actual IO index and the simulated riser sim that I constructed. We can go back even further with that simulated riser sim, and we're going to do so right now. This allows us to take a sneak peek back about 40 years. Now, over the long haul, and this is really interesting, and do keep in mind there was a big bond bull market over the past 40 years. The 60/40 and the 60/40 with riser or a strategy like it are going to be about neck and neck. The hedging really didn't do much over this period when you really zoom far, far, far out, except it does reduce your max drawdown a little bit, gives you a tiny bit of a smoother ride. But that's something to keep in mind. And that brings me to an important point. I said Riser is one of my favorite ETFs, and I truly mean that, but I don't use it. I toyed around with it starting back in 2022 for a few years and then stopped. Why? Well, as you'll learn quickly from watching my Miller Momentum channel, my implementation of my strategies doesn't involve directly investing in bonds except cat bonds. otherwise known as catastrophe bonds. And those aren't sensitive to rates. I have no bonds that need to be hedged. And if you're going to hedge a bond portfolio, you could use riser, but you could also use managed futures like DBMF. Um, or you could go all the way and just replace your bonds with DBMF. I mean, over the past 5 years, um, using DBMF did help with a 60/40 portfolio compared to riser. Let me do the back test here so you can get the labels straight. So this is the 60/40 with 10% in riser. This is the 60/40 with 10% in DBMF. And this is the 60/40 with the whole 40% replaced by DBMF. And you can see that the one with riser did do better than using just the managed futures for the 10%, but going all the way into managed futures just left both of the other options in the dust. And if we extend this by going back with riser sim and using DBMF sim, because DBMF actually has a preloaded index, it's available all the way back in portfolio sim to the year 2000, I believe. So we can just switch to the historical tickers and get performance on these indices. Now, riser sim, of course, is not an indice. It's just my approximation of an active strategy. But now we can see, zooming out, the 60/40 with the riser hedge, the 10% in a riser like strategy, is going to perform on the bottom of this. The 60/40 with DBMF used as the hedge instead, 10% in managed futures, does better than using interest only strips from mortgage-backed securities or using a shorting strategy on US Treasuries. And the 60/40 that drops bonds entirely and replaces them with managed futures just leaves the other two options behind. The reason being, managed futures can go long or short on rates. It dynamically adapts, and it also includes allocations to commodities where it can go long or short, or, long or short on equities as well. I mean, if you watch my channel, you'll know that I think, with good reason, that managed futures are the best thing since sliced bread, because they can go long or short on sliced bread. Well, at least on grains. Well, I hope you enjoyed this episode of Miller Momentum, and let me know your thoughts down in the comments. Do you use Riser to hedge your bonds? How do you approach bond investing? Oh, and don't forget to like and subscribe, because I've got a video coming up really soon about return stacking that'll tackle the big question: is it worth it? The answer? Well, you'll have to tune in to find out. Until next time.